In this learning, we are creating risk and reward worksheet and also graph and assuming that you are a put option buyer. So in this learning, we are putting you in the shoes of a put option buyer. The scenario is that you have purchased a put option and this put option you have purchased for a company Hypo ABC Limited, and this is the one which has expiration in coming December, and strike price or exercise price is 40, and in order to acquire this put option you have paid an option premium of $1. Before we get into worksheet and graph, we have to see that when you are a put option buyer, what is your outlook, right? In a previous learning, we have talked about the outlook of various option traders. So here you are put option buyer, so you are long on put option, therefore your position is bearish. It means you are having this outlook that in future on expiration the price of this stock would go down. What is your option premium? So option premium is the amount that you have paid. In this case it is $1 per share, and this option premium you have paid as put option buyer to the put option seller. What is your right as put option buyer? Definitely by paying this put option premium to put option seller, you have acquired the right to sell the shares, and you have acquired the right to sell 100 shares since it includes one option contract. What is your obligation under this contract? Well, you have acquired the right to sell the shares. The only obligation was the option premium that you had to pay, and you have already paid that to put option seller. So that is the cost of acquiring this put option. What is exercise price? The exercise price is $40 per share. So whenever you make a put option contract, you have to pay attention to the exercise price. This exercise price is $40. So which means that you have got the right to sell share at $40 each on expiration, and your outlook is of course bearish. So you are expecting that the share price would go down, so you can sell the share at $40 each, right? So maybe you can pick at in the market at lower than 40 and then you can sell at 40. So this way you will make the profit. So you will make profit when actually on expiration the price of share goes below the strike price or exercise price. So since your outlook is bearish, you are expecting that the market price of the share, which can be represented by ST, that is the share price, market price of the share at time t is expiration time, would be less than the strike price. So if this thing happens, you will be benefiting from this situation. So whenever you make an option contract, make sure you pay attention to the strike price or exercise price. And in this learning, we will be computing the payoff per share to the put option buyer, and we will also calculate profit per share to the put option buyer, and we will do that in a certain range of variation, and the range of variation is this one which I'm circling right now, from $34 up to $48. So we are assuming that on expiration the price of share can either be 34, 36, 38, 40, 42, 44, 46 or 48. So we will make our risk reward worksheet for these price variations. And remember, when you are a put option buyer, your payoff as a put option buyer is calculated as maximum of these two numbers, 0, and the second number is strike price minus the market price on expiration. Higher of these two numbers would be your payoff. But remember that as put option buyer, you have already paid option premium. So in order to calculate the profit, you have to deduct from payoff the option premium that you have paid to acquire this put option, right? Okay, let us go into the worksheet and do these calculations. The market price is 34, 36, and let us increase the variation, the range of variation, and we are taking it from 34 and we are taking it from 34 to 48 in the increments of 2. Exercise price is of course 40, and payoff is calculated with this formula which we have just seen. For first situation, payoff comes out to be $6. Naturally you were bearish and the price went down to 34 and you have the right to sell it at 40, so you are having a payoff of $6. But in various situations this would go like this. So your payoff would range from 6,4 to 0,000 in the situation when price is 40, 42, 44, 46 and 48. And remember, you have already paid the option premium to put option seller. So this premium has to be deducted from payoff to get your profit per share. And this comes out to be 5 when market price on expiration goes to 34. It is 3 when market price on expiration is 36, and then at 38 it is 1, and from 40 onwards profit is negative, which means loss, and loss is $1, and this loss is the option premium that you have paid as put option buyer. Since 100 shares were involved, therefore, so option contracts are 1, number of shares involved in the contract is 100, and then the total profit would be like this. So up to 38 you are making a positive profit, and when the price goes to 40, 42, 44, 46 and 48, you are having losses. And when we draw the chart, we see that here the break-even point is 39. So at 39 you are neither making any profit nor any losses, and since your position was bearish, so if the price is below 39, 38 or 36 or 34, you are making profit, and when the price goes above 39, which is your break-even point, then you are having these losses. So these profits are given, and these loss numbers are given in red, and this loss of minus $100 is just the representation of the fact that you will lose the option premium that you have paid to put option seller, because you won't exercise the right to sell the shares, right? So if the market price is 42, you will sell in the market at 42. You won't sell at the strike price of 40, right? So there is no fun of doing that. This graph shows us the risk and reward of put option buyer. Now let us extend our discussion to one more point, that what is your profit or loss if you had shorted the stock at $44. So if you had shorted the stock at $44, it means you had sold it, and later on you are expecting that price will go down and then you will buy it, right? So some of the traders are allowed to short the stocks, sell which you don't own, right? So here if you short at 44, right, this is the scenario that we are assuming here, that we have shorted it at 44. So if you short at 44 and later on the price goes down to 34, naturally you are making a profit of $10 per share. So if you times it by 100, you get a total profit of $1,000. But in other price situations, your profit will differ like this. And your break-even point, of course, would be 44, assuming that there are no costs of trading, right? So if you have shorted the stock at 44 and you purchase at 44, assuming no trading costs, your break-even in short selling is at the market price of $44. But if it goes above 44, naturally you are bearish and price is now going up, so you will lose. So this one we can present in a separate graph. So let us select these two relevant rows and then go and draw this graph. So this is the graph that we have. So this graph tells us that this is the profit or loss when you short the stock at $44 each and later buy on this stock. So this is the profit situation in various points. This way you can prepare your risk reward worksheet and also the graph when you are a put option buyer or when you short your stock and later on purchase it.